Part 1. $13 trillion in public debt must be rolled over within the next 12 months, while annual budget deficits remain at record levels never before seen in peacetime. This is not a conspiracy theory, it is a mathematical impossibility. As we enter 2026, the foundations of the global financial system are being shaken by an unprecedented event. The chairman of the Federal Reserve is officially under federal investigation regarding policy decisions and a lack of transparency in liquidity management. This video is not intended to incite panic, but rather to provide a cold, data-driven analysis of what is truly happening behind the closed doors of Washington and Wall Street. If you hold dollars, have savings in a bank, or are expecting a secure retirement, you must watch this entire video right now. The numbers do not lie, and they are pointing to a breaking point that no amount of money printing or interest rate cuts can salvage. History is repeating itself, but at a speed and scale that is far more terrifying. Part 2. Invisible cracks are beginning to fracture the balance sheet of the world's most powerful nation. The yield curve between the 10-year and 2-year U.S. Treasury bonds remains deeply inverted, a recession warning signal that has not failed in half a century. But this time it is accompanied by a more disturbing phenomenon, a sudden contraction in the M2 money supply while public debt explodes exponentially. Leading indicators such as the Purchasing Managers Index, PMI, and consumer confidence are sending out SOS signals that mainstream media is deliberately ignoring. Within the halls of the Treasury, Janet Yellen faces a harsh reality. Liquidity in the bond market is drying up. As bond yields rise to attract buyers, the interest cost on U.S. national debt has officially surpassed the defense budget. This is the starting point of the death spiral. We must borrow more money just to pay the interest on old loans, while the real economy begins to stagnate under the crushing weight of high interest rates. Part 3. The investigation into Fed Chairman Jerome Powell is not merely a political battle. It is an admission that the mechanism of monetary policy has spiraled out of control. Allegations focus on the manipulation of PCE and CPI inflation data to delay necessary tightening, allowing asset bubbles to inflate to terminal levels before bursting. Investigatory records suggest that major banks like J.P. Morgan were given priority access to emergency liquidity through stealth discount windows, while regional banks were left to wither and collapse. This lack of transparency has shattered the final vestige of trust in the central banking system. When trust evaporates, the USD is no longer a safe haven asset, but becomes an unpayable debt obligation. The mathematical impossibility lies here. To save the banking system, the Fed must print more money, but printing more money in a stagflationary environment will directly incinerate the value of that very currency. They are trapped in a maze where every exit leads to a collapse in purchasing power. Part 4. Looking back at history, we see haunting reflections of the 1929 Great Depression and the 2008 financial crisis, but with a more lethal variable: global debt levels. If 2008 was a crisis of subprime debt and investment banks like Lehman Brothers, then 2026 is a crisis of sovereign debt and faith in fiat currency. The parallels to the Weimar hyperinflation era are undeniable as the velocity of money begins to fluctuate erratically. History teaches us that when a nation can no longer service its debts with real income, it will always choose to debase its currency. The ultimate betrayal of the current financial system is its promise of stability while being built upon a massive Ponzi scheme, where cash holders are the ultimate bag holders. What we are witnessing is not a standard market correction. It is the end of an 80-year long-term debt cycle, a moment when real assets will reclaim their rightful status over the digital illusions on a computer screen. For Main Street, ordinary households in America and across the globe, the impact is a silent but devastating destruction. Mortgage rates remaining at record highs are strangling the housing market, making home ownership a mathematical impossibility for the younger generation. Credit card debt has surged past the trillion-dollar mark, with average interest rates exceeding 20%, creating an inescapable debt trap for consumers. The cost of living, from food to energy, has not decreased according to rosy government reports. Instead, real inflation is eroding wages faster than ever. As banks tighten credit to protect their own balance sheets, small businesses are failing en masse, leading to widespread layoffs. These are no longer distant macroeconomic theories. This is tangible pain felt in every utility bill and every grocery cart. The collapse of purchasing power means the middle class is being erased, pushed into the ranks of the new poor in an economy where money has lost its function as a store of value. On the geopolitical chessboard, the weakening of the USD is accelerating a de-dollarization process at breakneck speed. BRICS nations and emerging economies are feverishly building an alternative payment system detached from SWIFT and Washington's control. The greatest betrayal lies not just in reckless money printing, but in the weaponization of the financial system, leading both allies and adversaries to realize that holding U.S. treasuries is now a localized risk. As China and central banks worldwide aggressively dump U.S. debt to hoard gold, the pressure on the dollar has become suffocating. A multipolar world is emerging, where power is no longer based on aircraft carrier groups, but on the ability to maintain the integrity of a currency. The collapse of the American financial empire will not happen overnight, but the dominoes are falling. When the dollar is no longer the sole reserve currency, the U.S.'s ability to export its inflation will vanish, and the full price of decades of overspending will fall squarely on the shoulders of the American public. In the face of an imminent collapse, the survival strategy is no longer about seeking high returns, but about preserving capital at all costs. This is when the theory of financial self-sovereignty becomes more critical than ever. As the banking system moves toward bail-in policies, where your deposits can be legally converted into equity of a failing bank, keeping excessive cash in the traditional system is a fatal error. Gold and silver, the only true currencies that have survived thousands of years of history, are reasserting their role as the ultimate shelter. They carry no counterparty risk, cannot be printed by any government, and do not rely on the transparency of the Fed. The shift from financial assets to hard assets is accelerating. Every ounce of gold you hold is not a speculative investment, but an insurance contract against the collapse of fiat money. In an era of systemic instability, owning assets that you can physically hold and control is the only line of defense between prosperity and total ruin. Part 8. Bitcoin has emerged as a digital exodus in the crisis of 2026. Unlike gold, Bitcoin offers absolute portability and transparency on the blockchain, making it a perfect counterweight to central bank digital currencies, or CBDCs, designed for surveillance and control. The mathematical impossibility of U.S. public debt stands in stark contrast to the mathematical certainty of the Bitcoin algorithm. Only 21 million will ever exist. Institutional investors, after years of skepticism, are now flocking to Bitcoin as a final inflation hedge, as they realize the Fed has no tools left to save the currency's value. Self-custody of digital assets is no longer a hobby for tech enthusiasts. It has become a survival requirement to avoid future asset freezes or confiscations. Bitcoin is not just digital gold. It is a parallel financial system, providing individuals with true ownership in a world where private property rights are increasingly threatened by emergency government mandates. Part 9. The market's reaction to the Fed's desperate rate cuts in 2026 has revealed a fundamental shift in investor psychology. Instead of the usual rally, the stock market has responded with violent volatility and sell-offs as the fear of stagflation outweighs the hope for liquidity. The Fed is caught in a trap of its own making. If they raise rates to fight inflation, they collapse the banking system and the real estate market. If they lower rates to save the economy, they trigger hyperinflation and destroy the dollar. The investigation into Jerome Powell is just one piece of the larger dissolution of the myth of central bank omnipotence. Emergency rescue policies now resemble throwing gasoline on an already massive fire. The truth is that no monetary tool can solve a structural and mathematical crisis. As liquidity indicators flash red, we are approaching a Minsky moment, the point where debt levels become unsustainable and the entire financial architecture collapses under its own weight. Part 10. The true betrayal lies within pension funds and Social Security, where millions of workers place their faith in promises that will never be fulfilled. These funds are largely composed of government bonds and overvalued financial assets that will be wiped out in a currency crisis. When the real value of the USD drops, your retirement checks may stay the same in nominal terms, but they will no longer cover the most basic needs. This is a stealth confiscation of wealth, occurring slowly but ruthlessly through inflation. The mathematical impossibility of the current Social Security system is a ticking bomb that no politician dares to address. They choose to keep printing and delaying, but 2026 marks the moment when time has run out. Recognizing this deception early is the key to restructuring your portfolio, moving from paper promises to assets with intrinsic value before the exit doors are slammed shut to prevent a mass panic. Part 11. We must acknowledge that the commercial banking system is part of the problem. Under a fractional reserve model, banks hold only a tiny fraction of physical cash relative to customer deposits. In a crisis of confidence, even a small percentage of depositors demanding cash is enough to trigger a systemic bank run. Bail-in regulations have been quietly codified into law across many nations, allowing banks to use depositor funds to save themselves during systemic failures. This means the money in your bank account does not legally belong to you. It is an unsecured loan to a highly leveraged institution. Financial autonomy through holding out-of-system assets like physical gold and self-custodied cryptocurrency is not just an investment strategy, it is an act of protecting individual liberty. As the Fed investigation exposes the holes in liquidity management, the reality of banking fragility will become the focal point, forcing everyone to question where their life's work is truly safe. Part 12. Looking at the big picture, we are witnessing a fundamental transformation of global capitalism. The era of cheap money and debt-fueled growth is coming to a painful conclusion. What will replace it remains an open question, but it is clear that a new system must be built on a foundation of transparency and mathematical discipline rather than the subjective interference of central banks. The 2026 crisis is a harsh wake-up call regarding the cost of complacency and the danger of ignoring basic economic laws. The wealth gap will widen as those with financial literacy pivot to safe haven assets, while the majority remain trapped in a devaluing fiat currency. Social unrest and political upheaval are the inevitable consequences of currency collapse when the public's trust in government is betrayed. However, in every crisis lies opportunity. This is the time to educate yourself, to understand the true nature of money, and to prepare for a world where mathematical truth replaces the hollow promises of obsolete financial institutions. In conclusion, we are not facing a random disaster, but the inevitable result of a long chain of catastrophic decisions. The mathematical impossibility of saving the dollar in 2026 is a reality we must face with preparation rather than fear. The Fed chairman may be investigated, policies may change, but the laws of debt and inflation are unshakable. Remember, in history, no fiat currency has lasted forever, and the transfer of financial power is always accompanied by chaos. However, those who own real assets, hold gold, silver, and Bitcoin, and maintain an independent mindset will be the ones who not only survive, but thrive after the storm. Writing these warnings on the wall is not about pessimism. It is about providing you with a map through the gathering financial darkness. It is time to act before your options are narrowed. Subscribe and hit the notification bell to stay tuned for deep dive analyses, because in this war for wealth preservation, information is your most powerful weapon. The future belongs to those who see the truth before it becomes obvious to the crowd.